Hello everybody and welcome to another edition of BullionStar Perspectives. My name is Ronan Manly and today we have the honour of interviewing Rick Rule, who is a legendary precious metal mining speculator and investor. And Rick is CEO of Rule Investment Media and a director of Sprott. Good morning, Rick. How are you?
Good morning. I'm fine. Thank you for having me on.
Yeah, it's an honor. It's our honor to interview you. And I thought we'd start off by just looking at what's going on in the financial markets right now. We are really in extreme times with the dollar at a 20-year high, with interest rates taking off, with inflation at a 40-year high. Why do you think that the dollar is looking like it's the go-to safe haven in a relative sense more than gold at the moment?
I think my friend Doug Casey sums it up rather well. He describes the dollar as the prettiest mare at the slaughterhouse, which is to say that dollar strength isn't so much a reflection of the strength of the U.S. economy or the U.S. balance sheet, but rather the strength of the currency relative to other currencies. If you don't look at absolute strength, but look at the strength relative to the yen, the euro, the pound, the renminbi, by comparison, the dollar looks virtuous. Remember, too, that the U.S. dollar debt market, particularly the government debt market, is far and away the largest and most liquid securities market on the planet. It is also, for all of its faults, the most transparent. So I suggest that the U.S. dollar and U.S. dollar denominated debt issuances do well in comparison rather than absolutely.
Given that the US fiscal deficit is over 31 trillion at this stage and the 10-year bond yield is going a lot higher, and the fact that the strong dollar could act as a catalyst for various sovereign debt crises and currency crises around the world, do you see on the horizon the potential for the wider financial market participants to wake up and to realize that, as you said, the dollar is only attractive in a relative sense, but that when the dollar becomes an issue, that people will flock to precious metals, gold and silver?
As long as you give me the use of the word potential, I think it's a probability, but not a certainty. And I'd like to enumerate some of the things you said. The first is the $31 trillion in debt. Notice that that is only Treasury debt. It doesn't include the net present value of promises and entitlements that U.S. citizens have made to each other, Medicare, Medicaid, Social Security. The estimate of the U.S. Congressional Budget Office, not some cranky old libertarian named Rick Rule, is that the net present value, not the aggregate value, but the net present value of those off-balance liabilities exceeds $120 trillion. The other thing you said that I think really bears looking into is that despite the fact that nominal interest rates in the U.S. have doubled in 12 months, they're still strongly negative in real terms. The value proposition around the world's benchmark debt issuance, the U.S. 10-year Treasury, is as follows. The U.S. government promises to pay you 4%, which they will because they can print, in a currency where they suggest the purchasing power is declining by 8%. In other words, the value proposition around the world benchmark security is that they guarantee you a loss of 4.9% of purchasing power every year for 10 years.
So do you think that precious metals mining stocks are a lead indicator of the potential for the investment community to realize that gold is probably the only go-to asset once people realize about the defects in the US dollar? And over the last 6 months, the various gold mining and silver mining indices have been on a downtrend. But do you see that they have now reached a potential low and that it's a cycle and they are going to come back?
The question that you're asking is one, I think, that involves market psychology. And I'm a horrible one to ask. I don't own a TV. I can't dress myself without my wife's assistance. So talking about the impact of a narrative on a market is something that I'm uniquely unqualified to do. I can tell you reasons why a credit analyst or an investment analyst such as myself would want to have gold in his or her portfolio. And I can tell you too, statistically or numerically, why gold bucks, valued by the net present value of their future cash flows against enterprise value, are probably the cheapest that they've been in my career. I can tell you that the combination of the fact that I think gold and silver prices at some point in time go higher, while the equities of gold and silver prices measured empirically is the cheapest point in time in my career, it's relatively easy for me to say that I believe precious metals mining stocks for the right investors are good investments or good speculation. I would caution your listeners to understand that while I think an increase in precious metals prices and precious metals equities prices is inevitable, I'm not smart enough to know if it's imminent. The time frames involved might cause people confusion or trauma.
So that brings me to a point. I know you're a value investor, and I know you have maybe nearly 50 years experience in this area. I noticed that some of the Sprott ETFs use what I would call factor-based weightings in how they create the basket of stocks that they hold. And it's based on the sole active indices. And I used to work, I don't know if you know this, I used to work for Dimensional Fund Advisors, which was founded by David Booth. And it had on the board of directors Eugene Fama and Ken French. So while they believe in efficient markets, they also believe in factor investing. But I think that you would believe in inefficient markets, but also the fact that factors can influence returns. So within those Sprott gold mining ETF and the gold mining junior ETF, you overweight various factors. Would you be able to just explain briefly how you decide which mining companies are relatively better than others?
I would prefer that you ask that question of John Champaglia, who is still active in the construction of those factors that go into the ETF. One factor that I, as a Sprott director, never particularly liked was simply the equity's historic relationship to moves in precious metals prices, which was to say its torque. From a value investor's point of view, in rising precious metals markets, the least efficient producers enjoy greater margin expansion than the most efficient producers. So if you're investing for torque, you're asking companies in some measure to be inefficient. What I did like among the Sprott factors and continue to like about the Sprott factors has been the insistence on increasing revenues. Too often, mining companies enhance profitability by constraining sustaining capital investment, which results in diminished production, but better near-term financial returns. I certainly would agree that for me, factors-based ETF construction gives a better probability of a successful outcome than a pure market cap or market cap plus volume weighting, which basically just allows you to buy the market as a whole. I am not one who believes in the near term in an efficient market.
Yeah, I don't either, by the way, but when I worked for Dimensional, I probably had to pretend that I did. On a similar vein, I noticed that even though you have retired from your full-time roles with Sprott and you're still a director and a shareholder, you do have some portfolio management input because you run a separate account called the Sprott Rule Managed account. And I noticed, which is gold mining stocks portfolio. And I noticed that some of the themes of that, or one of the themes of that, is M&A, where you look for M&A candidates, merger and acquisition candidates. So do you think that we're at the beginning of a new, more active M&A activity in the precious metals mining space? And is it due to the declining discoveries?
I certainly do believe that the current boom in M&A and mining will be ongoing. And I believe that for many good reasons. The first is that the mining industry, not just the gold mining industry, but the mining industry itself, has underinvested in exploration and development for decades. And the consequence of that is that the new development pipeline around the world is in attrition. And the big mining companies simply must buy their way into relevance again. The second reason is probably as important as the first, which is to say that capital markets around the world value size and liquidity more than anything else. Building sufficient mass and sufficient trading volume lowers your cost of capital relative to smaller peers. And in a capital-intensive business, a lower cost of capital is absolutely vital in the struggle to thrive. The third reason is a bit more subtle, which is to say that larger companies have the ability to lower their general administrative expense as a percentage of assets under management or as a percentage of revenue. They have the ability to make investment decisions over more alternatives. So the possibility exists that larger companies can be run more efficiently than smaller companies. The truth is, in the mining business, this is seldom proved to be the case. But I think that's a fault of management inefficiency rather than a function necessarily of the sins of a larger company.
And that brings me to another related point, that some of the work that you still do in conjunction with Sprott is that you offer a service called the Rule ranking of precious metal stocks. And you offer the ability of people with existing portfolios that you and your colleagues will rank those names and give feedback as to whether you think which ones are good in a relative sense and which ones are bad. Would you like to explain about that and whether it's open to anybody like the general public and the viewers of this show?
I would love to, but I need to say that this service is solely a function of Rule Investment Media. It's not a service offered up or endorsed by Sprott. I continue to have access to the best thinking at Sprott, but I get the bows and I get the blames associated with rankings. It's all me. And the answer to the question is yes, it's open to everyone. Anybody who cares about my opinion as to their natural resource stocks, note, natural resources only. No pot stocks, no crypto, no tech stocks. Keep me with what I know. Simply needs to go to ruleinvestmentmedia.com. There you can enter your natural resource stock portfolio. And at least for those names I follow, there's about 800, I and my team, I will rank them 1 to 10, 1 being, in my opinion, best, 10 being, in my opinion, worst. Where I think that my comments might have value, I will comment on individual issues. Further, for any of your listeners who would like to avail themselves of this service, if any of them are accredited investors, now that I'm no longer part of Sprott, I can inform them for free which private placements I'm participating in. I don't charge for the service yet. I may someday. But if you are an accredited investor and you want to know what I'm doing with my own money, I'll tell you what and why, so far at no charge. When you go to the Rule Investment Media site, at the bottom of the rankings database, you'll see questions and comments. Just simply write placements. So I'm happy to do both of those things.
We will put those links on the video when we publish it. I wanted to turn to silver, and I know that I saw an interview that you did maybe 2 years ago, and you were talking about PSLV and the fact that, and I think it was just after the silver squeeze as well, that PSLV was getting a huge amount of physical in and it had to get it from various countries. And right now what we're seeing in LBMA is that over the last 10 months, there's been a huge outflow consistently for 10 months of a total of 300 million ounces of silver out of the LBMA vaults. And likewise on COMEX, the registered stockpile is diminishing and it's at a 5-year low. And actually the LBMA vault silver totals are at an all-time low since records began. So there's something definitely going on there with huge outflows of inventory. What's your take on it, and who is creating this relative excess demand?
Well, the who is something that I can't help you with, not because I'm unwilling, but merely because I don't know. One might assume that the takers of physical metal who are withdrawing inventory from the Western system are people who have political fears of the West. That could be China, it could be India, it could be Saudi, it could be individuals that are associated with those regimes. It makes perfect sense, given the extraterritorial nature, particularly of U.S. power, how people who are afraid that they might run afoul of that extraterritorial power would prefer to have their inventory not in the hands of somebody who they think might be of a mind to punish them. I am interested in the drawdown in inventory, and I'm interested in that for a variety of reasons. For me, the principal reason is that the paper market, the futures market in silver, is so much larger than the physical market, but the paper market is always reliant on the physical market for settlement. And I'm nervous now about float to stock, which is to say that so many transactions take place relative to, if you will, the collateral for those transactions, that I think people do need to begin to be considered about settlement failures. You will note that when there is a settlement failure in the futures markets, the futures dealers take care of themselves. They don't take care of their clients, as we saw not too long ago with the rogue Chinese trader. And people who are active in the paper market, I think, need to visit with their banks, visit with their advisors, and think of the advisability of undertaking a transaction with the expectation of payment when there may be insufficient liquidity, and there certainly is insufficient will on the part of the dealers to guarantee a fair and efficient market.
Yeah, and the other variable that people, I think, need to be watching out for is that in London, most of the physically silver-backed ETFs vault their silver in London. So when the LBMA comes out and says there's like 28,000 tons, about 18,000 tons of that is already allocated to ETFs. So it makes the float even lower. I was looking at one of your previous interviews when you were talking about uranium stocks. And when you look at uranium, I think you also look at inventories. And because inventories is a very important variable and metric in that market. Would you like to comment about where you see the uranium price right now and the uranium stock prices, the miners, and has the global conflict centered on Ukraine and Russia and the energy crisis given an extra boost to your thesis about what's going to happen in uranium?
Answering the questions in reverse order, I suggest that the tensions between Russia and Ukraine and Russia and the West has brought back into focus the idea of energy security. I think more importantly, in terms of the near-term price moves in uranium, that Japanese restarts, the restart of the Japanese nuclear fleet, will be of more immediate importance. Remember that Russia supplies about 7% of world uranium production, although they provide about 40% or 41% of enrichment and re-enrichment capacity. What that means in the near term is that blenders and fuel processors are going to overfeed, which is to say they're going to use more raw U3O8 relative to enriched than they otherwise could. And I suspect in the very near term there's sufficient inventory. What will, I think, move uranium prices is simply the pace of Japanese restarts. That's what moved the uranium price down, if we go back to Fukushima. It's important to note, too, that globally we use more uranium now than we did before the Japanese shut down their nuclear fleet. So the restart of the Japanese nuclear fleet is, in fact, icing on the cake. They could store enough uranium in Japan in one warehouse to power Japan for 5 years. You can't store that much liquefied natural gas. You can't store that much coal. So I think in Japan, two things have happened. One is the popularity among the Japanese public of the Japanese commitments around the Kyoto protocols and the fact that uranium generates electricity without generating carbon. The icing on the cake, I think, for the Japanese, or at least for Japanese public opinion, has been a reawakening of Japan's sense that the energy security offered up by uranium, particularly as global macroeconomic hostilities make security of supply interesting. I think what that means is that uranium is on its way to being priced at or above replacement cost, which is a substantial premium from here.
So I noticed that you, in various interviews, and everybody knows that you're a libertarian and you subscribe to a libertarian philosophy, and you also support institutes and educational institutes that educate people about libertarianism and free market, small government. I was looking recently at a number of articles by, say, Greenspan and others about the link between gold and economic freedom, liberty, even peace and prosperity. What do you think it is about gold that allows it to be this unique asset that will provide peace, prosperity, and economic freedom?
Gold is the only commonly accepted medium of exchange that's simultaneously a store of value. Gold isn't a promise to pay, it's payment itself. If you are paid in fiat currency, you are paid in credit. And if your debtor decides not to pay, you aren't going to get paid. With gold, he doesn't have to pay you. You've already been paid as soon as you receive the gold. A transaction in precious metals traditionally has involved no coercion. If the U.S. dollar was really such a good item, there would have to be no law mandating its acceptance in the United States. You wouldn't need to coerce people to take something that they had a desire for. The heart of libertarian philosophy, from my point of view, is a belief in a world that's based on convincing people, not compelling people, an absence of coercion. And the fact that gold is, and has been for thousands of years, in many cultures, had high intrinsic value itself, means that it is a store of value while it's a liquid medium of exchange. And it's a medium of exchange that requires no counterparty trust and no coercion.
You probably would be interested in, you may have seen US Congressman Alex Mooney, Republican, introduced a Gold Standard Reserve Act. And he's the same politician who's previously introduced audit the Fed and audit the US gold reserves. You probably subscribe to or support that, but what kind of chances or probability do you see of any of those acts of Alex Mooney ever getting on the floor and getting voted on?
Arithmetically, there's no real such thing as sub-zero, but I see the probability of sub-zero. People go into government because they want power. They want to be an arbiter in a variety of exchanges of goods and services. Honest currency, a gold-backed currency, diminishes or eliminates that power. They would then have very limited role in quantitative easing, which you and I would call counterfeiting. Anything that diminishes the power of the political class, I would suggest, has no chance of succeeding. And frankly, I don't think that most of the voters at present want to control their own financial future either. I think most of the voters want to consign responsibility or blame for the outcomes to their elected leaders. Most people don't want to be coerced, but they feel free to coerce. They believe that their narrative, their paradigm, their list of wants and needs is superior to other people's wants and needs. And as a consequence, they feel perfectly comfortable in enforcing their narrative over other people using the mechanism of the state.
So if you were addressing an audience and you were asked what is the primary reason for holding gold or silver, physical gold or silver, is it as financial insurance against calamity, or is it as a portfolio diversifier of an existing portfolio of stocks and bonds, or is it for another reason, as you mentioned in your answers about the fact that gold is not a promise of payment, and it actually allows or provides liberty and economic freedom?
Where gold fits in a portfolio really depends on the portfolio and the psyche of the owner of the portfolio. For me personally, physical gold represents insurance. Gold has done well during periods of time when investors are concerned about the maintenance of their purchasing power in conventional fiat instruments. The arithmetic around the US 10-year Treasury is sufficient inducement to me to be concerned. When gold establishes the momentum, silver runs further and faster. And the most volatile assets of all in the class are the silver stocks. The market capitalization of silver equities is so small that when the generalist investor begins to understand how to spell silver, there isn't sufficient market capitalization. There isn't the size of the silo to accommodate the cash that comes into the sector. I've watched this happen twice before in my career. And at age 69, I'm sort of eager to enjoy it one more time. Now, understand that that portfolio rationalization is mine personally. Other people's rationalizations, other people's motivations might be very different within their portfolios. But for me, gold for insurance, silver, and particularly silver stocks, because they're such outrageously volatile speculations.
And turning to the organizations which represent gold and silver miners, the World Gold Council for gold miners and the Silver Institute for silver miners, do you think both of those organizations are doing a good job, A, representing their members, and B, in general, representing the physical metals?
I think they're both doing an adequate job. I think they could both do better jobs. But I think they represent the industry that they support. And I suspect that the policies and paradigms of both organizations reflect the wishes of the executives around the companies that support them. I believe that both organizations could do a better job in marketing. I believe that most organizations, well, I should leave it there.
Okay.
I think they do a job that they are mandated to do by the people who provide the funding for them.
And probably less people will recognize the name Shareholders Gold Council, but the Shareholders Gold Council was an initiative which I think maybe 3-4 years ago, a bunch of hedge funds, mainly in New York, got together and created an organization that was meant to be beginning to represent, as the name says, the shareholders of gold mining companies. But it's been very low key, and they've only produced a few little research reports. Do you think that that was a bit of a damp squib, or that it didn't really get off the ground because of lack of support?
I was an initial funder. I liked the idea that a group of investors could or would form an organization that reflected their own interests, as opposed to having their interests reflected by, say, the World Gold Council or the investment banks, whose interests may be different than the investors' interests, or the issuers, for that matter.
Yeah.
I was particularly eager to write a check so that I wouldn't have to undertake the work myself. Trying to represent the interests of investors against other established interests in the space is hellishly hard work. And I'm delighted that the Paulson organization, among others, took it on themselves so that I wouldn't have to.
Yeah, I was talking to Sean Filer a few months ago, who we interviewed, and I know that Lawrence Leopard was also, his fund was also one of the backers of it. I was very enthusiastic about it when I heard about it at first, but then it was a little bit disillusioned that it didn't really do as much as I expected. Maybe that was my own personal expectation. I wanted to ask you about the Rule Symposium, the event, the annual investment conference, which you have already had this year, and it's going to be on, is it July of next year? So how did the event go this year, and what was your vision when you created it?
I had organized that symposium for the Agora Publishing Group almost 30 years ago in Vancouver, and I assisted in putting it on, and I would have preferred that it remained their conference. I took over that conference from Agora Publishing about 15 years ago when they simply abandoned it. When your best clients tell you that you will do something because it's an important part of the value of the relationship, you do it.
Yes.
And I did it. And we had a very successful conference business in Vancouver, conferences not being my main business. until COVID hit, which precluded many foreigners from traveling into Canada, meant that for 2 years we couldn't put on the conference at all. And this year we had to move the conference to the United States, which is where most of the attendees were. Very recently, like last week, we polled all of the attendees from all of the conferences that we have access to and asked them if they would prefer to return to Vancouver or if, all things being equal, they would prefer to remain in Florida. So next year's conference will, because the attendees have told us it will, be in Florida.
Okay, great. Maybe I'll even go myself. So it's in
I look forward to that.
July 2023.
Yes.
I wanted to ask you, you mentioned that 30 years ago in Vancouver reminded me of a story I read recently about when you arrived in Vancouver, when you were 18 in the early days, you actually ended up owning a bar in the financial district. And at that time, the clientele was probably a list of all the mining executives in Vancouver. Could you give me a little background or reminiscences about how that role and that ownership of that bar influenced your career in the precious metals mining sector in Canada?
Sure. I arrived to Canada as an immigrant, and like many immigrants at age 18, I had no money. I had to work at night to go to school during the day. The only transferable skill that I had in the United States was I was a large guy, and I'd boxed for 10 years. And so I got a job immediately on landing in Vancouver as a bouncer on Skid Row in a really, truly ugly tavern. And I was able to work my way up to nicer establishments until, through a series of management mistakes, I was given the opportunity to first manage a bar in bankruptcy, and then buy a partnership in the bar that you mentioned. And the bar was, in fact, headquarters, if you will, after hours headquarters for mining company executives, but also the nascent investment banking scene in Vancouver, the sort of, Peter Browns, John Tognetti's, those guys. And it was an invaluable education for me. I can say this now. Peter will laugh. I would ply him with whiskey or whatever it was that he wanted at that point in time, ask him some questions, excuse myself, telling him I had some work to do, run in the back of the place with a 3x5 notebook and write down his answers, come back, pour him another drink, ask more questions. And I probably received the most candid MBA in natural resource finance in that bar, which is to say from the School of Hard Knocks, and also the most valuable that anybody has ever witnessed. I got to see the deals getting done. I got to witness firsthand and later participate in all of the plotting and scheming that went around precious metals sausage making, if it were. I got to see who the good guys were, and I got to see who the bad guys were. And I got to learn very quickly how to spot the differences, which has served me well over time. That's not to say I haven't always been successful. It's not to say I've never been fooled. But I certainly have, since that point in time, gone in wide open, eyes wide open.
That's fascinating, Rick. I can actually visualize it. I could see a movie out of this. They could make a movie about your life. I'm sure there's a huge amount of material starting in those early days in Vancouver.
Several people would need to die before that movie was aired.
So it's been really good talking to you. I think we're going to wrap up. So thank you very much for your time. And it's a pleasure talking to you. And the audience are going to love this. I'm really sure of that.
Oh, my pleasure. If they like it, have me back. I'm always willing.
Oh, we definitely will. We will definitely have you back next year, sometime next year.
Thank you. Great.
Thank you, Rick.